Right, stock market update, probably the most important one of the year, really, because what do you do with the gains you've had so far when the market's falling? Let's have a look at that in immense detail. Yes, things are expensive, but that's not why the market's falling, because they were expensive before it started falling, and suddenly it's not discovered expense as anything other than an excuse. The reason is sentiment and momentum, which is often the reason, and they find excuses through things like expense. So pretty much everything's gone down, but we will look at some of these bellwethers which haven't fallen, like Nvidia, or some which haven't fallen as much, like Amazon, some which have gone up, like Cisco, during the course of this broadcast. Now, price earnings growth ratio, you want that to be below 1 for it to be good value. And again, you can see that everything's expensive. You're looking for an excuse. Where does that leave us? Well, the Nasdaq's still up 34%, but it was up 44% at its peak this year. So we've got decisions to make. Do we sit back and see all our gains we've made this year lost and depleted and get punched in the face? Or do we hold on or sell, or whatever do we do? Now, that's what this video recording is going to be about, and let's have a look at it in some detail. The S&P 500, there you see, there's the falls. What does it actually mean? And I really want to educate you in this at the same time. The least important indicators of momentum, price momentum, are the stochastic, the weekly, and the monthly. However, they are the most early. So the benefit is they're the least important. The cost is they're the most early and can remain overbought for a long period. So they're giving us an early confirmation of an early advance warning that this is going to fall, and is going to fall more likely for a slightly longer period. And let's not forget, almost certainly into September as well, because September hardly is an ever an up month. So we're probably looking at this happening. Okay, now slightly more important is the weekly MACD, and that's almost certainly going to fall like this, whereas the dotted one is the monthly, and that hasn't quite fallen, and it's difficult to know whether it'll do this or come back again. I'd probably say we're going to get this fall and then this resumption, and that's probably my best guess at the moment what's going to happen. Now you might say, well, wait a minute, if we're going to end up where we are now by the end of the year, why would I not just exit everything? And that's really the main decision for most people to make right now, is should they just sell everything and take the gains that they've had this year, because they've had some great gains. Now that depends on a couple of things. First of all, do you like trading your investments? If you like to trade your investments in and out, and you've got the time and the energy and the inclination, which most people don't, then you would. Otherwise, you'll sell between 10 to 100% of it. Now, some of you might sell 10% of your Apple, some might 20%, 30% on these. Okay, and depending on your risk aversion. So you can see it's likely to fall, and if you've got the time, energy, and inclination, you may well trade it, but if you haven't, you would just hold on and invest like Warren Buffett does. And you can see the banks would be on your side. You'd take some warning that you're definitely going to get slapped and punched in September by Apple, just so you know. And this weekly is likely to do this. How do we know that? Well, because it tends to do it in the past as well. It takes a bit longer to go down, and that's likely to do this. So you are looking at some more prolonged downward moves. Now, has that got to do with Apple iPhones and all the rest of it? No, it's to bloody well do with sentiment, momentum, and direction, really. Okay, and if it didn't, those pattern recognitions we can see there, which correlate with those patterns, and those patterns wouldn't keep on happening. And if you don't believe me that they keep on happening, well, there you are. You can see what happens in the past as well. Alphabet, it's holding up better than, say, an Apple. So with Alphabet, you might not hedge it. You might not sell 10 to 100%, or you might say, well, yeah, actually, I think I will. I think I'll go into cash in everything because I'm risk averse. Or you might say, I'm risk loving. I'm in it for the long term. I'll stay in. You've got to decide, what's your risk appetite? That's the first thing. And what's your time period for holding? Now, everybody thinks in a rising market, their risk appetite is huge and their time frame for holding is forever. It's when it's falling, like now, that you determine what your actual risk appetite is. Okay, and given that your risk appetite is suddenly likely to bloody well shrink right now, chances are most of you are thinking, do you know what, I might sell 50 to 100% of this holding that I've had since January, because I want to pocket some of those gains. Now, the danger with that, of course, on the flip side, is when it starts going up again, like this, let's say, that bottoms out, you'll have forgotten and have missed it. That's the famous, oh, if you missed the 10 best trading days in the last decade, your returns would fall. That's what it's about, okay? And the chances are, unless you're going to consistently look at this like I do every week, every month, you should probably just hold on rather than trying to trade your investments. Similarly with Microsoft, that's where we are with it. and it's likely to do this. It's fallen off a bit. I've been happy to hedge. I have some short positions in the short term on Microsoft, but that's my business. That's what I do. For you, you probably won't hedge that. You haven't got the time, energy, or inclination. You'll probably sell 10 to 100% of it in order to get out of it. Okay. Amazon's holding up, but you can see what happened with Apple and Microsoft, and you might say, I'm not hanging around, mate. I'm getting out of between 10 to 100% of it. Or if you're more risk-loving and a longer-term holder, you just keep on. Now, don't buy Disney just because I've shown you this chart and it looks like at multi-year lows, because that would be a completely different strategy to the one that I say. If you're on my Great Investments program, you'd already know we look at value, growth, income, cash flow. That's how we determine whether to get in. And this would not meet that criteria. Don't care what the analysts say, let alone the fact that this is August, September, and October are pretty bloody awful months anyway for Disney's. Why the hell would you be in it right now? So I certainly wouldn't be buying Disney at the moment, but it's a bellwether. So I'm just showing these. I don't just want to show tech stocks. Nvidia has become a bit of a bellwether. It's falling off a bit. Again, same decision. Do you sell 10 to 100% based on a broader falling market, based on how well it's done so far, based on momentum? If you're risk loving or you want to have a strategic investment in this for the long term, you'd hold on, even though you might see it fall and take away some of those gains you had for so long. If you're risk averse, you'll sell 10 to 100%. If you're sophisticated, you might short it in the short term, but that's a different investment. That's trading. Okay, similar with Tesla, similar kind of story. I'm not going to re-explain that to you. If you're not on the Great Investments program and you've not had a fantastic year, then get on it. Have a look at alpeshpatel.com/links. Meta, again, the decision for you to make. Do you, if you're a sophisticated trader, do you short it to hedge your existing position, or do you get out right now because you're thinking, thanks very much, I've had great gains, I don't want to see those gains whittle away? Or you're a long-term holder and more risk-loving, in which case you just hold on even though you know it could do this, because look what it did last year. Now, I've had some people who fell asleep at the wheel last year, didn't listen to any of my broadcasts and didn't get into cash, saw it drop here, then saw this 200% rally and said to me, I'm only up 4%. Yeah, well, if you fell asleep and didn't look at that and didn't do anything, then that's fine. 4% is what you deserve. But if you're willing to listen to weekly broadcasts, and occasionally when they say, ooh, unusual time, we sell into this, then you missed all of that and you gained all of this, in which case you're fine. Okay, so you can't have it both ways. You can't say, I want to be asleep at the wheel and get my 200% return. You cannot have it both ways. You can't have your apple and eat it, as it were, or your Meta and eat it. So it's up to you. And the bare minimum you've got to do, the bare minimum, and I've simplified it, is just watch the weekly broadcasts and then decide your risk appetite and whether you're willing to hold for the long term, or if you're a short term holder. If you're a short term, then you've got to put more effort in to get the better returns. Okay, effort returns. Okay, now, ServiceNow, it's hurt me. And I've hedged this, I've got a short position in the short term, but I've not sold out of it completely, though I could have sold out of it and got back in later. But it's hurting me because it's falling. And that's fine. It'll probably do this and then go up. It's not a bad company, okay, at all. But I just don't want to suffer some of those losses. So I've hedged it a bit. If you're not willing to hedge, you might sell 10 to 100% of it and take your profits. Or equally, you might say, well, actually, it's a solid company. I know I'm going to get some losses. I'm going to see some gains go into negative, but I'm willing to do that in order to just have an easier life and hold on for the longer term as per the flow chart, which I show you all. And the flow chart's on alpeshpatel.com/links. Don't forget to look at this, campaignfor1million.com if you want to see more. Thank you very much.